2 weeks ago, excuse me, an Australian health tech startup, which was founded in Sydney just 7 years ago, was acquired by a New York listed healthcare giant for $1.6 billion. That company was Eucalyptus. They're a private Australian health tech startup, and they build and operate direct-to-consumer telehealth brands. And they focus their online platforms on providing patients with access to medical consultations, prescriptions, and ongoing care for health conditions like weight management, sexual health, dermatology, and hair loss. Typically things that have a stigma attached to them, right? Now that might sound super simple, but actually taps into a very deep and very sensitive consumer psychology, and one that existing healthcare pathways simply weren't able to address, and in my view would never be able to address. It's very, very difficult for a large institution to be able to think about these kinds of nuanced innovation and to deliver them effectively. These kinds of innovations are almost always done by startups. Often you'll hear questions like, aren't you concerned about, X company or Y company doing the same thing? They're much bigger and they're in the healthcare space. The fact of the matter is, most institutions, most of the legacy players are just not equipped to innovate. And so the greatest value that gets created in the private markets happens at the startup space, from early stage through to growth stage. Now with Eucalyptus, they conducted their first capital raising round in May of 2020. It was a relatively modest $8 million that they raised. After that, they went on to raise 5 different rounds of capital, each time offering the private market the opportunity to acquire their shares at the next valuation, and the one after that, and the one after that. And then, as I mentioned last week, those shares were acquired for $1.6 billion. This all happened without any ticker code. There was no analyst coverage. It wasn't included in any index. Just a lot of hard work by a founding team and the people that they brought around them to take a customer problem and solve it using a technology company. And to their credit, they did that with the support of their shareholders and their investors exceptionally well, and built for themselves and their team, and for the shareholders that backed them from an extraordinary amount of wealth. And that was wealth that wasn't built on the ASX. It didn't happen inside an ETF. It happened nowhere near the public markets. It happened entirely in the private markets. And the thing about this story that matters the most, in my view, is Eucalyptus is not an isolated example. This is a pattern. As more and more companies choose to stay private, the best companies in the world, the most valuable companies in the world, the most innovative and arguably the most interesting companies in the world are just not available on the public markets. And that's showing. So when you unpack the data on the public markets, this is JP Morgan data. Their view is that the listed markets are declining at the fastest rate in 25 years, and they're forecast to continue to decline into the immediate future. 81% of companies that earn more than $100 million a year are private. 81% are private, which means only 19% of those companies are available to people who invest solely through the listed markets. Even the indexes are now heavily weighted towards a handful of companies for their performance. And yet, by comparison, the private markets have grown spectacularly in the last 2 decades and are forecast to continue to grow into the next decade with, different forecasts, but this forecast from Atlas suggesting it will reach 21 trillion by 2030. And we think that's conservative. If you compare the data from the private markets and the public markets side by side, it becomes absolutely clear that the investment markets are undergoing a fundamental structural shift from public to private assets. And so if investors want diversified access to the true universe of corporate stocks, you have to have a private market strategy. Now, the good news is that we live in a country where more unicorns are built per dollar of capital invested than anywhere else in the world. More than the US, more than Israel. And as the Australian innovation ecosystem the private markets that support that, the regulatory infrastructure that supports that, the mentorship and the support that sits around entrepreneurs that are building their company from seed all the way through, the accelerators and the incubators, that entire infrastructure, as that continues to build and grow, the rate of success will also increase. It is also the case the Australian venture capital and private equity consistently outperforms public markets in the medium to long term, according to analysis that was conducted by Cambridge Associates. The next generation of high growth companies in AI, in health tech, in defence, in advanced manufacturing are all being built right now, and they are being built privately. We believe that the next decade will deliver some of the most extraordinary growth in corporate value that we have ever seen, and that the majority of it will be done in private companies. And so the question for investors is simply this: how will investors gain access to curated, quality, private company investments? How do they position themselves right now for the exposure to where the next decade of returns are being built? And that is exactly why Sydney Angel Sidecar Fund was established, to give as many people as possible the opportunity to have exposure to a curated, diversified portfolio of quality private companies for a relatively low investment minimum. We'll come to that later on. And I'm thrilled to say that the fund has been very, very well received by the market. To give you just a quick breakdown of some of the technical aspects of the fund that come up all the time. Adrian mentioned it is an incorporated limited partnership. So all investors will be limited partners in the partnership. It's a direct interest, there's no intermediary. The Early Stage Venture Capital Limited Partnership Program is a federal program that is designed to incentivise people, investors, to participate in funding the commercialisation of technology companies. And to do that, government uses the one lever it has at its disposal, and that is tax. First of all, there's a 10% tax offset that you get for the investments that you make in that financial year. And then all of your returns from a unconditionally registered ESVCLP are completely exempt of income and capital gains tax. When I was a partner at PwC, I set up a lot of VC funds around the place, many that are still operating now. Most of their minimum check sizes are $250,000. We wanted this fund to be accessible to as many people as possible. And so the minimum investment is only $25,000. And it will be called in 5 equal tranches over 5 years, which means you can participate in the fund for $5,000 now, $5,000 next year, $5,000 the year after that, and so on. You will be joining 80,000 registered members, 4,500 wholesale certified investors who have invested over $440 million with us across hundreds of projects in multiple asset classes. We have intentionally tried hard to build a reputation for quality investments, not for volume. And investors have rewarded us with 57% repeat investment rates and an average of $45,000 per investment. And that discipline has translated into returns as well. So 600% returns in venture capital is the highest so far, well done, and and up to 40% in our property equity deals in only 12 months. We genuinely believe that the next decade will deliver some of the most extraordinary growth in corporate value that we have ever seen. And the majority of that growth will be in private companies.